Dogecoin has just cleared a meaningful technical hurdle, trading around 24 cents after breaking through the multi-week resistance near 23 cents. And that single price action has flipped a lot of market psychology from wait and see to position and prepare. On the opportunity side, the setup is deceptively simple and powerful. A breakout above a well-watched horizontal resistance converts prior sellers into new buyers, creates a visible support band for traders to anchor risk management, and attracts algorithmic flows that chase momentum. Add to that the fresh narrative fuel Polymarket's market-implied odds for a spot. DOGE ETF approval jumped sharply, reported moving from roughly 51% to 71% in some feeds, which immediately reshapes expectations about future demand, product availability, and the scale of institutional on-ramps that could someday buy and lock Doge at scale. Then layer on the behavioral evidence. On-chain and market data show whales quietly accumulating between 18 cents, 23 cents, and per derivatives trackers. More than $12 million of new long exposure opened in a single day, a concentrated, leveraged bet that large players expect follow-through rather than a fake-out. Finally, the regulatory backdrop shifted meaningfully in recent days, with executive-level moves that opened the door for crypto. Allocations into retirement accounts, a development now being digested by plan administrators and asset managers, which, even if indirect, amplifies the narrative that crypto, and by extension, high-liquidity tokens like Doge, are becoming more accessible to mainstream capital. Put all that together, and you get a plausible runway. Breakout confirmation above 23 cents that holds as a new floor. Continued whale accumulation that reduces available sell-side float. And a credible pathway for productization spot ETF staking like wrappers or 401k vehicles that could bring material persistent demand. In an environment where liquidity stays ample and macro conditions remain risk-on, this kind of structural change can convert an ordinary breakout into a sustained trend that composes the kind of asymmetric upside that traders dream about. Even the distant-sounding $2 target becomes imaginable if a chain of big, durable flows materializes over time. That said, the path from 24 cents to $2 is not linear or inevitable. The risks are concrete, immediate, and serious. The first and most obvious caveat is scale. A move to $2 implies an enormous increase in market capitalization and sustained capital inflows that dwarf the one-day accumulation headlines and speculative chatter. For Doge to hit $2 in any reasonable time frame would require repeated episodes of megaflows into meme cap assets, structural adoption by custodians and ETFs at scale, or a foundational change in the token's utility, none of which are guaranteed by a single breakout. Second, leverage and derivatives dynamics cut both ways. The same $12 plus million of new longs that signal conviction can also create vulnerability. If momentum stalls or a surprise headline hits, leveraged long positions are the first to be liquidated, producing sharp downside cascades that can erase weeks of gains in hours. The market's recent behavior, a swift short squeeze, followed by anxious repositioning, is a textbook example of how fragility grows as leverage concentrates. Third, narrative risk is as real as balance sheet risk in meme markets. Odds and 401k policy shifts are powerful narrative accelerants, but they're also fragile. Odds on prediction markets swing quickly on rumor and sentiment. Regulatory actions that appear accommodative can still face legal challenges or slow implementation, and executives' policy decisions take months to filter into actual products and flows. The executive-level order-loosening 401k constraints, for instance, is impactful for long-term institutionalization of crypto. But that is a process, not an immediate faucet of capital, and it will be staged, regulated, and litigated. In parts, fourth, liquidity depth matters. Breaking through a resistance on moderate volume is one thing. Holding through multiple time frames on strong spot volume and declining exchange balances is another. If the breakout lacks breadth, for example, if it's driven mainly by retail FOMO and derivatives, while exchange inventories and large wallet behaviors remain ambivalent, the move can devolve into a classic by the rumor Sell. News event, when headlines peak and new buyers freeze. So, how do we reconcile the bullish probabilities with the downside mechanics in actionable form? Start by treating the current breakout as a conditional thesis rather than a binary bet. Bullish scenario, a base case, is that 23 cents flips cleanly to support. Whales continue to accumulate and derivative funding remains stable or slightly positive. In that case, Doge can grind higher toward intermediate targets, 30 cents. Where profit-taking and tightening of stops would be normal, the more aggressive bullish thesis scenario B needs 3 durable confirmations, persistent. Exchange outflows indicating longer-term custody rather than intraday rotation. Growing institutional custody inflows or ETF subscriptions, or credible commitments to them. And measurable product launches that broaden real-world demand payments, integrations, merchant adoption, or retirement plan instruments. If those align, then multi-bagger moves become a plausible long-term outcome. Conversely, the bear or fragile scenario C activates if the breakout fails to see sustained volume. If derivatives positioning shifts toward reloading shorts at higher strikes, or if a macro shock triggers rapid deleveraging, in that fragile case, a retest of the 18 cents 19 cents band is likely exactly the area whales have been accumulating, so the question becomes, will those same whales defend the area, or will they choose to distribute into another wave of retail demand? The answer will reveal whether the breakout was a change of regime or a pump and dump in slow motion. For traders and allocators, practical risk management matters more than conviction slogans. If you're a tactical trader, consider scaling into positions. Buy a base layer on confirmed closes above 23 cents. Add incrementally on sustained volume or on a successful retest of the new support. And use trailing stops just below the 23 cents area to avoid being caught in a liquidity vacuum. Keep position sizes small relative to portfolio risk tolerance, because meme markets are capable of 30 to 50% intraday swings when sentiment reverses. Hedging via options where available can be useful. Owning calls for upside with a small proportion of premium risk, or buying puts as insurance, can let you participate while limiting asymmetric downside. For longer-term investors who view Doge as a strategic speculative allocation, dollar cost averaging into weakness, particularly into the whale accumulation band of 18 cents, reduces the risk of timing mistakes and aligns exposures with the thesis that the current institutionalization trend is multi-year rather than instant. Monitor key signals, exchange flows, derivatives open interest and funding rates, Polymarket and similar market-implied probabilities, and on-chain large wallet behaviors, because these will flip the thesis from plausible to improbable faster than price alone. Keep an eye on catalysts and antis, because they will determine tempo. Positive catalysts that increase the probability of sustained upside include formal SEC movement toward approving spot Doge ETFs or clear regulatory guidance that reduces custody friction. Major custodians or asset managers announcing product commitments. Concrete 401k rollouts that actually include crypto line items. And continued measurable reductions in exchange Doge balances as whales and institutions withdraw tokens into long-term custody. Negative catalysts include regulatory reversals or enforcement actions which have immediate, high-impact price consequences. Public statements from powerful institutional actors discouraging allocations to memecoins, sudden increases in exchange, supply due to sell-side pressure from a large holder, or macro tightening that drains risk-on liquidity from speculative corners of the market. The Polymarket odds spike in the 401k executive news are powerful accelerants. But remember, they are inputs into a much longer supply-demand equation. They don't guarantee instant 5 or 10-fold reevaluations. Finally, temperament and time horizon should guide behavior. If your time frame is days to weeks, treat Doge as a momentum instrument with high implied volatility and design trades accordingly, smaller sizes, defined exits, scanning for gamma and funding changes. If your horizon is months to years, allocate only what your psychology and liquidity needs can withstand. DOGE narrative. A shift from speculative meme coin to a more institutional-friendly asset over the next several years. But that transition will be jagged and will test resolve repeatedly. Whether the bulls can actually drive Doge to $2 depends on a concatenation of events. A durable flip of 23 cents into support. Continued whale accumulation that meaningfully reduces exchange float, concrete institutional products and flows, and a macro environment that favors risk and allocation. And while each of those pieces is observable and trackable, none is assured. For now, the market offers a compelling, high-probability trade in the short run, a confirmed breakout with clear stops, and a speculative, lower-probability long-term dream of $2 that would require sustained scale-moving flows. Recognize the distinction, calibrate exposures accordingly, and let the data, not the hype, dictate whether you amplify your position or step to the sidelines.